Accounts receivable. Cash due from customers who have purchased merchandise or received services not yet paid for. Increased when a sale is made. Accounts receivable is decreased when a sale is collected. Converted to cash by collection, discounting, or factoring customer accounts. Accounts receivable. AR. Before doing accounting, I had no idea what accounts receivable was, but it is a very, very important thing. It is a very, very important asset that appears on the balance sheet. But what is it really? We got that definition, it doesn't really make any sense. So, at its most basic and fundamental level, when I sell something, when I make a sale, when I get on my 80s phone and I'm like, wow, you ordered $1,000 of Accounting Play product, but I have not yet shipped that product. How does that work? I make a sale. So I make a sale here. And I make that sale for $1,000. When I make that sale and I have yet to receive any cash for it, that's when I also increase my accounts receivable. AR is also 1,000. And this is an accounting debits equal credit, so there's always two sides of a transaction. What is this AR? This is money owed to me, right? This is your cousin. This is your kids that owe you money. This is your... We'll leave it right there. But really, in accounting, accounts receivable is what your customers owe you. Because in business-to-business transactions, it's not always just cash. People literally pick up the phone and say, yo, Billy, send me a part. Okay, Billy, whatever. They send him the part and they bill him for it. The process of billing records a sale and accounts receivable. At my firm, when I do a $1,000 accounting project, I also record $1,000 of accounts receivable. And then I have to call, hey, Billy, where's my $1,000? So at its minimum, it's performing a way of tracking what's owed to you. Now, once stuff is actually paid, you get the cash. Yeah, $1,000. And AR now gets decreased. You no longer have to track Billy who owes you the money. It's a beautiful thing. So AR goes away. And you're ultimately left with a $1,000 sale and $1,000 cash. If it was just a straight cash sale, if everything was just so instant as it is in places like desert locations that take a lot of cash from you, you are in a different scenario. But in places that do business the good old-fashioned way, you make the sale, you increase the accounts receivable. When you collect the cash, AR goes down. So here, sale goes up, AR up as well, right? Accounts receivable is a good thing. It's a value. It's money owed to you. In a CPA firm, it's a little bit simple. Hey, look, I sent out the bill, brother. Now pay me some money, please. And then I collect it. I get the cash in, and then I take the debtor out of, out of AR. I think even in England they call it the debtor's account. The debtor's account, John Gillingham CPA, Accounting Play, right? But in America we call it accounts receivable, AR, accounts receivable. also known as receivables. Hey, what's in receivables? Now, if you have enough money in receivables, it becomes a significant part of your balance sheet. For example, I have a client that's a foods company, and their AR right now, something like $100,000, because they've sent out their product. They've made the sale. So it's owed to them. So their AR is a huge asset to the company. Now, if they're ever short on cash flow to actually pay their employees and stuff like that, then they can do things like factoring and discounting, which is a technical terminology for borrowing in essence or getting paid for the fact that they have this value. So they can take this and give it to someone else for them to collect, or they can say, hey, look, bank, I have this in receivables, it's going to be coming, please loan me some money. Now, any large corporation, any large balance sheet is going to have significant accounts receivable, and accounts receivable will have an aging, much like accounts payable will. Now, accounts payable is the opposite of accounts receivable. So when I just do a little balance sheet, assets equals liabilities plus equity, AR is right here with an asset. And accounts payable is going to be the other main side of that. So we have assets equals liabilities plus equity. And we're talking about assets where we have things like cash, bank CDs, right? Money market accounts. But right up there in value is going to be AR. The liability opposite of what we owe is going to be accounts payable. So within this AR, there's also an aging. What is an aging? AR is like, when are they going to pay us money? So we have current, right? Good customers, 30 days, 60 days, 90 days plus. So even though your AR says 100,000, it's going to break down in this current. Let's say most are pretty darn current. We have like a late person or more, no one at 60, and then 90 plus we have this other 10,000. So we have these super late comers. So because we just book a sale when we think the company deserves it under GAAP or generally accepted accounting principles, United States, we need to decide, hey, are these good? 90 days plus? Is this still good? If we're not sure, we can set up what's called an allowance. So we might have an allowance say, hey, look, allowance for doubtful accounts, uncollectible accounts, maybe 5,000, more advanced concept. So what we're really reflecting in our accounts receivable is 95,000, because a lot of these receivables aren't going to actually get collected. A little bit more advanced. In essence, receivables is money owed to the company. It's valuable. It's a good thing as long as they're legitimate. That's why we have the aging, to make sure that they're not too old, or else we write down the accounts receivable or create an allowance for doubtful accounts to reduce it. That would be a contra asset advanced concept. Allowance for doubtful accounts, accountingplay.com. Thank you.